Today we are looking at the Atlanta Metro Statistical Area rental market for multifamily properties. So let's go in and first check out the filters that we're going to be looking at. As usual, we are excluding all corporate, all military, all senior, and all vacation, and we are only including market and market/affordable for the rent type. We've done this for all the videos up to this point. I am going to do something slightly different today, so stay till the end of this video, because at the end I am going to compare the Gwinnette County to the Atlanta MSA, because I'm going to get some pushback from some naysayers that are going to say, well, Gwinnette County is more of an affluent market and it's more booming than the Atlanta Metro is because of all the different areas in the Atlanta Metro. So you really can't say that because Gwinnette County is still moving strong. Well, we'll go take a look. So what I'm going to do is we're going to look at the Atlanta MSA like we do with all of them. We'll look at the overall, then we'll look at just Class A, just Class B, just Class C, and then we'll go and change our filter to Gwinnett County and look at just the overall, all Class A's, B's, and C's together, because I don't have time in order to do the A's, B's, and C's separately for Gwinnett County, or this will end up being a 30-minute video, and I don't want it to be that long. As it is, it's probably going to go 20 minutes. So hang around to the end and see the comparison between just Gwinnett County, a submarket of the Atlanta MSA, compared to that Atlanta MSA. So let's go to our analytics and look at our supply side snapshot. So as we can see, let me go down to our vacancy here first. So we have our all-time average of occupancy over the last 22 years, and we can see that the long-term average is 91.47%, and that it's currently sitting at 91.11. If you are familiar with the market cycle chart, then you know that that horizontal line across the market cycle chart is the long-term occupancy average. So as we can see, Atlanta has fallen below that long-term occupancy average, which on the supply side probably is going to put it in a recessionary state, depending on what the rents look like. If rents are declining, if absorption is stopping, slowing to an almost crawl, or actually exiting, then these are all indications that Atlanta has moved in to the recession cycle phase number 4. All right. Right now we have that indication, but we'll look deeper into this. So total inventory is 492,000 plus units for 4,244 properties. There are still 33,000 under construction, with only 466 absorbing over the last 12 months. That does not show a very good tale. And we have increased from 6.1% a year ago in vacancy to 8.9%. So a 2.8% increase in vacancy, decrease in occupancy. My guess is there's a major exodus coming out of this multifamily market. Could be due to affordability, just could be oversupply, and the fact that there's still 33,000 units to deliver is probably going to tell a pretty bad tale. So let's go look at the analytics. So here we are for our overall, all A's, all B's, all C's for conventional apartments in the Atlanta MSA. We always look at effective rent. Asking rent means that the property management companies and owners are asking for this, but they're actually receiving effective rent. So if we look at first quarter 2022, it was $1,615 a month, went up to $1,660. And at that point, the market said, nope, that's it. That's all we can stands. We can't stands no more. And down it starts to trend. We can actually see that we are lower in the fourth quarter of 2022 than we were in the first quarter. And even though we're still showing rent growth, albeit very, very small for the year, if you're getting information from a broker's going to hand you an OM and say, look, we have rent growth in 2022. So we have continued opportunity to continue to grow rents in this market. If you look at it on a quarterly basis, it tells us a different story. So let's see why we're having rent decline. I can have a pretty good idea at this point, but let's go take a look. So we can see that we have 2,249 units delivered in first quarter, 2,678 delivered in second quarter, 5,175 delivered in third quarter, and 4,535 delivered in fourth quarter. Wow, that's a lot of units. What do we got here? We got 9,000, 9,700, 11,000, 13,315, almost 16,000, about 15,500, 15,600 units delivered. How many absorbed? Whew. That's ugly. That's all I got to say about that. That is ugly, folks. So out of almost 16,000 units that delivered, you actually have negative absorption. So if we total this up, we have 1,010 moved into the market, and it looks like 9. So you had some. So we got about 30 people absorbed 16,000 units. Folks, that ain't going to work. And there's still 33,868 units left to be delivered. Atlanta, sorry about your luck. You are definitely in recession. There's no doubt your oversupply situation is really, really bad. So let's go compare the A's, the B's, and the C's and see where this is happening. So that said, I'm going to go look at the Class A space first. All right, so here is our Class A data. Again, effective rent. And now we're actually showing a year-over-year decrease in rents. The only other market I've seen that in is Phoenix at this point. And that was just a quick look at Phoenix. We have not done a video on Phoenix yet. We started the year at $2,006 per unit. Again, these are just Class A's. Went up to $2,067, and once again, the market said, nope, don't like those rents. It started to trend down, and now it is actually below where it started at the beginning of the year. It's actually below where it was in the fourth quarter of 2021, which is what indicates that negative growth. So let's see why. And if we head over, we got a portion of, so what do we have here? We've got 66, 86, 91, 10. So about 66% of the units were Class A that delivered. The other 33% will be Class B. And if we look at absorption, we did have some absorption, but nowhere near what we delivered. So we're right around 10,000 plus for deliveries. We're sitting at 38, 40, 400. So about 40% absorbed, 40, 44% absorbed. Not good, folks. Not good at all. We want to see 80+% absorption to stabilize a market. This is definitely slowed to a very big crawl, which is a big indication of why rents are declining and why occupancy is declining as well, from 93% in Q4 of 21 to 89.3%, taking it below that long-term occupancy average. So the A's are definitely factoring into the equation of this market declining. So let's go look at the B's. So here is our Class B data. Looks like we're about $500 lower in rents. We started at $1,569 in Q1, went up to $1,608, and as with the overall and as with the A's, the Class B said, that's about all we can take, and it starts to trend downward from there. We're actually $1 less than we were in Q4 of 2021, but of course that's going to show 0% because $1 will not show a trend yet. You got to get to $1.50 to show 0.1 decline for that specific target. So we are starting to see decline. Well, it's been declining since second quarter, but we are now seeing negative rent growth year over year based on the data we're seeing. So why is this occurring? So let's go look at the B's. Oh, that's not good. So B's delivered somewhere around 4,500 units from the look of this. And it looks like nobody moved into them. As a matter of fact, there were 11, 16, 2,400 approximately out of the 4,000 that actually left the market, which is leaving over 6,000 units vacant in the B space. So there is a major exodus happening in the Class B market. So if you are purchasing Class B properties in the Atlanta MSA, you best be careful and look at your data carefully. There is a major exodus happening here. Okay, so let's see and there's still 8,333 units left under construction. Whew, not good for Atlanta. This is not a good sign. This market is definitely in the recessionary phase, without a doubt. So let's look at Class C's and see what it tells us. So here's our Class C data. Once again, effective rent. Looks like we started the year at $1,217, went up to $1,251, actually increased in third quarter. A's and B's decreased, albeit slightly, and then a very slight decrease in the rent in fourth quarter. So you've got what seems to be a strong rent growth for the Class C market, 6.4 year over year, 1183 to 1258, albeit we are now starting to see a downward trend. Let's see if the deliveries, well, there won't be deliveries, but let's see if the absorption supports this. Oh, and that answer is a definite no. So the fact that we have people leaving this market to the tune of, what do we got here? That's about 700, 1,400, almost 2,000. So we got almost 2,000 people with no deliveries that have left the Class C market. So you have more people leaving the Bs than are being delivered. You have more people leaving the Cs than are being delivered, even though there's nothing being delivered for Cs because you don't build to the C. And the only thing absorbing were the A's, and they were not absorbing well at all. So these rents do not support this absorption, which is strange, which tells you that the ethics for apartment owners are out the window, because there is definitely not rental demand to increase these rents because your occupancy is decreasing. When occupancy decreases, our rents decrease. That is how demand and supply works. But these apartment owners are increasing their rents because they believe they can because of the demand in the market. So the renters are saying, you know what? You guys can shove it up your butt. We're not going to rent your units, and we're all going to move in together, and let's see how your demand is affected that way. And that's what's happening. That is what I believe is happening in this market, because people need to work. They work in the Atlanta area. It's not like they're going to move to Macon and drive to Atlanta. So they're just doubling and tripling up. And so that's why you're seeing this negative absorption, or at least that is what I see in this data and how I'm interpreting it. The only other way to interpret this is that these people have moved out of the rental market and into the purchasing market. But with home prices the way they are in the Atlanta MSA, I doubt that's the case. And with the way interest rates are, a more logical reason would be that they are doubling and tripling up, which is heavily affecting the demand of the market. So for those of you that are purchasing in the Atlanta MSA, be very, very, very cautious. This market is obviously in the recessionary phase, which means that it leads every other market we've looked at so far. So once we get all these units online and starting to stabilize, of course, there's going to be a big downtrend in rents here. Expect a 20% or more decrease because of all these units to be delivered. But as these units will start to deliver again, Atlanta should be one of the first markets to start to head back up the other side. So do not discount Atlanta because of that, okay? All right, let's change our filter now. I'll pause this for a second. I'm going to change the filter to Gwinnette County, and we're going to compare the overall rents, all asset classes, to the MSA and see if the argument of this is a more affluent area and a stronger market actually holds. All right, so you can see I've changed the filter. We are now just looking at Gwinnette County, which is a submarket of the Atlanta MSA. You can see the downtown area inside the loop here, with the airport being down in this area down here by College Park. All right, so let's just look at Gwinnette County. Again, the filters are still the same. We haven't changed the filters, where we are excluding corporate, military, senior vacation, and just doing market affordable. And I have not selected any of the asset classes. So there are 374 properties in this market. Let's go look at our supply snapshot. So we have 66,889 units, 6,500 still under construction, 1,153 absorbed in the last 12 months, with about a 50% reduction from the previous, maybe a little less than 50% from the previous year. Vacancy is increasing, 5.5 to 7.6. That is a 2.1% vacancy rate. Remember, we were 2.8 for the Atlanta MSA. So it looks like that Gwinnette County is following the Atlanta MSA. So let's go down and look at our long-term occupancy average. We can see that the vacancy rate is below the long-term occupancy average, putting Gwinnett County in that recessionary cycle as well, because we have gone below that market. But let's look and make sure that we are seeing rent decline, because this shows a rent increase. Let's make sure we are seeing a rent decline, and obviously we're increasing in vacancy, which is typical for that recessionary phase. So let's look at the data. So here's our overall data. Again, we're just going to look at all units. We don't have time to go into A, B, and C. We're already at 16 minutes in this video. So we can see that we started at 1,600 at the beginning of the year, and we finished the year under what we started at the beginning of the year. And we are just barely slightly in rent growth year over year. Next quarter, this is definitely going to be a decline. I don't think there is any question about that whatsoever. So let's go look and see what our construction, absorption, and deliveries look like. So it looks like we got about, we got 13, 17, 50, 25. So about 2,550 units delivered. And we absorb, so we do have some absorption. Absorbed looks like to be about 900. So you're about 60% absorbed to deliveries, but we can see that it is definitely slowing. So absorption is slowing, which is causing the reduction in occupancy for this market, which will start declining those rents. So it's not as bad as the MSA, but it is trending the same direction. And you still have 6,575 units to deliver with this slowing absorption. So in order to deliver and fill these units, these rents are going to have to decrease, because as this occupancy increases, those rents are going to go down. All right. So Gwinnett County is following the Atlanta MSA. It's just not as drastic yet, but it is heading in that direction. So that'll do it for the Atlanta MSA and Gwinnett County. Look tomorrow for the Mobile, Alabama MSA, which is where I live. So I'm going to do the combined statistical area because of the employment in Mobile. You have Mobile County and Baldwin County, even though they are two separate MSAs. I'm going to combine them because they share the same employment center inside of Mobile. All right, so I will see you guys tomorrow.